Hello, this is Pascal again. So I am going today to show you how I evaluate the statistics of a long trade for the company MYL, which is called, I think, pronounced Milan in English, maybe Milan, I don't know. Anyways, MYL. Okay, so we can see that MYL is in an uptrend. You have the 50-day moving average here. You had a few breakouts, and now some sort of cup and handle pattern with two small breakouts indicating that maybe the stock wants to move higher. So we are going to test here the statistics regarding a possible breakout above this current range. Before doing that, I first look at the pyramid. What is the pyramid telling us? So I click on the pyramid and okay, I will type the ticker. So what does it say? So it says that we have large players accumulating, which indicates that probably this small range will break to the upside. We have very strong accumulation. We have a supply that is 0%, which means that it is a very stable stock. And the rest in general is positive. The only negative is that the market is still in some sort of short mode, but we are basically in the trading range, and we have been in the trading range for a few months. Okay, so let's go to the breakout calculator. This is the breakout calculator. So what I will do now is first download the data. I will go on the download icon. I type the ticker. I have to tell if I want to be long or short, so it's a long trade. And let's see what is going on. So, okay, everything has been downloaded. Here I have to start putting numbers here. So the first number is the number of days that I have to use for the probability evaluation. So if I go back to here the chart, we can see that we have been in an uptrend for quite a long time, maybe 1 year, something like that. So we could use 200 days for past evaluation. Usually to evaluate a breakout, you can use a quite large number of days. You could use easily 500 days because a breakout is not trend dependent. When you evaluate a specific trend, then you need to use the number of days that correspond to the trend. But for a breakout could happen even in a downtrend. Therefore, you can use any number of days that you feel good with it. So usually I use between 250 and 500 days. Let's take 250. Okay. As a stop level, because it's a breakout, if I leave the breakout calculator to calculate himself the stop level, the stop will be put below the envelope, which is 3.5%, and because we are going to break out, the stop will be rather high. So let's do it like that, but first I need to tell to the software, to the breakout calculator, what type of trade I'm going to test. So it's a long trade, but it's a breakout. Very simple. So I execute here a first calculation. What is the breakout price? Okay. So the breakout price is very important to tell. let's go back to this figure. We can see that the breakout price should be above 74. Let's go back here, maybe 74.5, 74.6. Okay, so let's put 70. Okay, here we see that the high of the previous days was 74.66. That was the maximum. So I'll use 74.7 as the breakout price. Okay. No, the software will calculate what it needs to calculate. You don't see it because it's done at the right of the screen, but it will come quickly with a result. Okay, so what we see here is that the breakout is not very good because the risk return ratio is just higher than 1. It is not good enough. Also, the stop level is rather high. Usually I prefer to put a stop that is maximum 2.5% for a breakout. So I put here 2.5%. I will erase this stop level here. So now the breakout calculator will recalculate everything using that stop level. Okay, so let's launch the calculation again. And so the price is still 74.7. Okay, so we see this moving. Normally the stop level wouldn't change that much the risk return ratio. Okay, didn't change much. But if we use now a breakout calculator, a breakout on volume, which means that we are going to test a breakout, but only on a strong volume. Okay, let's do it. It's 74.7. Okay, so we see now that the probability of having a good trade on a breakout on volume are much better. So what we should do now is to evaluate the entry price. Now we have used 74.7 as entry price, but if the market opens at 75 or 76, should we still enter the trade? This is why it's useful to have the sensitivity analysis. So let's use the sensitivity analysis, and we see with the sensitivity analysis that we are going to test the different entry price. You see, entry price increase from 74.89 to 75, and then we see how the risk return ratio changes. You can see here that the higher the price, the fewer trades are generated. But still, okay, now it starts to become blue. It means that if the price gets higher than 76.59, maybe it's more difficult to make money. So that's it for this presentation. Here are your settings for the trade for the next day. You should enter the trade if you have a breakout on volume above 74.89 or 74.7 until 77.55. Thank you.